Welcome to another exciting edition of Business Finance. Yeah, my voice is a little bit hoarse, so I'll try to make this as quick as the computer allows. I've already had to start and stop this thing one time because it just simply didn't want to work as I had hoped. So, a couple things this week. We'll, of course, go over the Chapter 11 assignment, rip through that, and you guys have a quiz, but you've also got your outline to do, and so I'll spend a little bit of time talking about the outline and where we ought to be. You'll notice that we do have an assignment for Chapter 12, but Chapters 13, 14, and 15 we do not. Okay, and there won't be assignments, or as quizzes do. We kind of get away from some of the quantitative things there, and so your quiz is largely going to be based on getting information out of the text. But then my admonition is that you have 3 weeks there where you don't have assignments, and thus I would fully expect that time be spent formulating the best paper possible for your project too. So please don't disappoint. Talk about the assignment first. Your guys' assignment was problems 1, 2, I forget what all they were, and of course my computer now doesn't want to work. God. Maybe it'll kick in here, so we can talk about the NCAA March Madness, and hope everybody's bracket is doing well. Yeah, it says that I'm not. There we go. It does say I'm recording. So now let's see if we can make this thing work here. Or maybe I'm not recording. Yeah, it's kind of working, but it's certainly not wanting to bring up. Okay, so you guys have problems 2, 4, 6, 9, 11, 14, and 18 that are due. Okay, and so I, of course, have done some samples for you, starting with ones that are similar. And as soon as my Excel gets up and working here, I will be happy to do that. So, yeah, the brackets, I know a lot of people get busted. They always do, and at this time of year. I'm still rooting for Gonzaga and Utah. Gonzaga just because they're Gonzaga. They've been kind of a Cinderella team in the past, and then I got to root for Utah because their coach Larry Kristoviak is also he's from Montana. He's also my sister-in-law's cousin's husband's brother, before the cousin actually had passed away long. So I'm kind of a sure-tell relative of Larry, so you know. Anyhow, it's a long story actually, and it's actually even more complex than that. But for that reason and other reasons, I root for Utah. So, okay, here we go. Problem number 1. I'm just talking about weighted cost of capital. So you guys have 2, which is very similar, but in March 2010, for one, it says Hertz Pain Relievers bought a massage machine that provided a return of 8%. It was financed by debt, costing 7%. In August of 2010, Mr. Hertz came up with a heating compound that would have a return of 14%. The chief financial officer, Mr. Smith, told him it was impractical because it would require the issuance of common stock at a cost of 16% to finance the purchase. Is the company following a logical approach to using its cost of capital? Now, mine would have been mine would have just been a simple verbal answer, but yet I'm going to go ahead and calculate and say, no, probably not. What we'd need to know is what their mixture is, right? I think your guys' question is, yeah, debt and common equity each represent 50%. And so in order to do this, similarly, you know, I'll use that 50% number for my example and show you how you'd calculate it for your. So if my weight for my debt and my weight for my equity are each 50%, my cost of my debt's at 8%, okay, and my cost for my equity is 13.5%. For mine, actually, my cost is I've got to change these numbers a little bit. Okay, my cost of debt is actually 7%. And I apologize, my machine bogs completely down whenever I have to use this BB Express. So it's 7% or 0.07. And my cost of equity is 16% or 0.16. Okay, and each are 50%. And so what I do is just figure out my weighted cost, which is simply taking the 50% times the 7%, right? So this is just simply equal to this times this, and that's the weighted cost. Okay, and 50-50, I just simply add the two and I get my weighted cost is 11.5%. So really, if I took a look at number one, I've got a heating compound that's going to return 14%, and my cost of capital is only 11.5%. I should jump all over that. Okay, that would be a good thing. The massage machine, on the other hand, that had the return of 8%, probably doesn't give me a good return. It's not giving my shareholders a good return. So maybe not something I should consider. Okay, onward we go to, you guys have 4 and 6, and so I did number 5, and I think number 5, maybe it was representative of both of those, right? Your 4 is telecom systems can issue debt yielding 9%. The company is in a 30% tax bracket. What is its after tax cost? Okay. And basically, yeah, your number 6. Your 4 and 6 are very similar. Your 4 is just a word problem. 5 and 6 are both simply put out. They actually just give us the numbers. And so what we have is calculate the after-tax cost of debt under each of the following conditions. And it calls it a yield, or our cost of debt is either 8%, 12%, or 10.6%. Corporate tax rate is 18%, 34%, 15%. Okay, so what is my after-tax cost of debt? Well, what that's saying is that if I borrowed $100, right, I'd pay $8 in interest, but I get to deduct that $8, right? I get to deduct that $8 from my taxes, and so I save taxes on that share of it, on that $8. And if my corporate tax rate's 18%, okay, then what I save gets deducted from the $8 that I pay, right? Or you could look at it another way and say that I'm going to pay taxes really on just 82% of that $8. Okay, so the formula that we need to use is simply this. It's simply going to be equal to my cost, or my yield, they call it here. It should be the cost of debt, debt cost, debt percent, debt rate, whatever. Okay, so 8% times my corporate tax rate, my tax rate, minus my yield, right? Okay, that's one way to calculate it. So what that's equal to is saying equal to this times my, I'll leave parentheses, my corporate tax rate minus my cost. Parentheses, sorry. And so, yeah. Oops, I came up with the wrong answer. What the heck did I do wrong? Oh, I should be, I'm sorry, it's minus. I thought that didn't look right. So instead of multiplying, I got to do a minus. Golly, I'm sorry. I'm still got it wrong. Holy cow. What in the heck did I do wrong here? Okay, it's C9, so it's my corporate tax rate minus my corporate rate times, that's what I'm doing wrong, I'm sorry, my corporate rate times my yield. Gosh darn it. And that's really what I said to begin with. So let's start all over again. So it's my yield minus my corporate tax rate times my yield. There we go. 6.56. Okay. Remember, I said if you were paying $100, right, you'd pay $8 worth of interest. Okay. Oops. But you'd get to deduct that $8, right? And your corporate tax rate's 18%. So that means you're going to save that 18%, okay, for this $8 that you get to deduct, right? So you could do this one of two ways. You could say that this is equal to my corporate tax rate times this, okay? So I save $1.44, and so I can say that's equal to this minus this. So my cost in that case was $6.56, and since my original debt, or my effective cost is $6.56, and remember I said I borrowed $100, right? And so boom, it would equal that 6.56% interest rate, 6.5% effective rate. Okay, once I've done the one, sorry for the lengthy explanation there in my foul ups, but once I've done the one, I can simply drag it down, right? Then the other ones become pretty easy once you get the formula in there. So that's one of the easier ones. Sorry, I stumbled over that one a little bit. 6, you guys will be just like ours. So we go on. You guys have number 9, I believe it is. Yep, and so I've done number 8, which is similar. So 8 says this: Royal Jewelers Inc. has an after-tax cost of debt of 7%. With a tax rate of 35%, what can you assume the yield is on that debt? Okay. Whoa, that's not the same 8 that I have up here, so I must have a different problem going. I'm going to pause and get that one straightened out for you. So do number 8. The one I did was, hang on here a second, the one I did was an example of number 9, similar to what you guys had for number 9. So 8 was completely different. I'm sorry. Airborne Airlines Inc. has a $1,000 par value bond. So it's kind of asking you here, if you reissued some debt, you know, what's going to happen with that is basically what we're going through here. And so set it up. It gives you the certain details, and I just changed the numbers. Your guys' numbers are the same, but you want to set it up in a similar fashion. So the par value is 1,000. Your guys' par value is 1,000. The interest payment, okay, I'm saying that mine's 105. Yours is 88. The price, your guys' price is 950, and I just said that mine's 880. And the maturity is 30 years, right? Okay. So my interest is 10.5%, right? This is equal to this divided by my interest payment by the par value. Okay, so it should be 10.5%. There you go. Okay, but the price is below the par value, so the price has gone down. So I know that yields in the marketplace are now higher, right? When the price goes down, the yields go up when we're talking about bond prices and whatnot. Okay, and my maturity is 30 years, so I really want to calculate what the current yield to maturity is based on this price. Okay, and to do that, I simply come down here and hit delete. We'll redo her. So okay, I know, remember that I'm looking for a higher one, and of course I showed you what the answer was going to be, but my number of periods is 30. Again, your guys is 25. My payment amount, and I'm going to put that in as a minus, is 105. All right, my present value is the current price, which is that. My future value then is going to be a minus 1,000. I'll get $1,000 there in the future. Okay, so my yield to maturity is 11.99, or just about 12%. So it says compute the yield to maturity on the old issue and use this as the yield for the new issue. Okay, make the appropriate tax adjustment to determine the after cost debts. So, and it's in the 40% tax bracket, right? Okay, so my new yield for if I issue a new debt, it's basically, if using my example, it's going to have a payment of $120 if I round that up to 12%. Okay, my tax bracket's 40%. So in order to calculate this, it's just like my calculation up here. In fact, I could copy this, right, and paste it here, and it should be the same. Okay, and that works. Okay, or I can put the formula in, which is simply equal to this, my yield to maturity minus, again, my parentheses, my tax rate times my yield to maturity. Ooh, does that make that so darn long? Okay. So 7.19% would be my after-tax cost of debt in that case. Okay, your guys would be a little bit different, obviously. And we go on, and I've got number 11. You guys have number 11, and so I think I did one that was similar. I just kind of used made up some more numbers. So Terry, your company, is in the 40% tax bracket and has a bond outstanding that yields 10% to maturity. So if I had a $1,000 bond, that would mean that it's $100 a year in interest payments, right? What is Terrier's after-tax cost of debt? Assume that the yield on the bond goes down by 1 percentage point, and due to tax reform, the corporate tax rate falls to 25%. Ooh, what is Terrier's new after-tax cost of debt? Has the after-tax cost of debt gone up or down from Part A to Part B, and explain why? Okay, and so your guys is 10%. I think I used a 5% yield to maturity, and I said that we had a 42%, okay, 42% tax bracket. And so again, I just calculated what my after-tax cost is, which is, I could simply copy and paste, right? My formula for up here says effective rate, okay, or after-tax rate, whatever you want to call that. My effective rate, then, if my yield to maturity is 5%, I'm in a 42% tax bracket, is 2.9%. And then I've kind of done the same thing. Assume that the yield on the bond goes down by 1%, so it goes to 4%. But I said, and the corporate tax rate falls to 25%, and I did use the same number. Then what happens to my effective rate? So it actually, the combination there actually made my effective rate go up a little bit, okay, because taxes went down, right? Then so it's kind of a goofy, almost seems what would you call that? It's not intuitive, that's for darn sure, right? Your rate went down, your taxes went down even more, and so your actual effective rate actually went up a little bit. So kind of a goofy thing. That's what financial planners get to mess with. So just so much fun. 13, I think you guys got 14, and I did 13, which I believe is similar. Medco Corporation can sell preferred stock for $90 with an estimated flotation cost of $2. It's anticipated the preferred stock will pay $8 per share in dividends. Compute the cost of preferred stock for Medco. The cost of preferred stock, it's given in a formula. I think those formulas are on page, they're kind of listed in a nice setting on pages 361 and 362. And I just put it over here, right? It's the cost of the stock is equal to the dividend divided by the price minus the flotation cost. Okay, so it's a relatively simple formula, and we can just put this in. We're going to need the dividend, which we have, divided by the price minus the flotation cost. So we can put those in parentheses so it works right, but we'll just say it's equal to dividend divided by, hit both, divided by percent, the price minus the flotation cost. Okay, what's a float cost? Just to throw that out, that's just a cost of actually issuing the debt, right? You're going to have to pay an investment banker, and you're going to have to pay some folks, and so you're going to net, right? If you issue $90 in debt, it's what you're going to net. $88 is what it amounts to that you're going to have to use, and so it's just recalculating. Then basically, it's saying the $88, and you're paying out a dividend of $8, so your cost is 9.09%, right? So that's all you're doing there. 18. And I did 18 in a similar thing. I actually used a real company just to take a look at it, because I think that's kind of interesting. And I chose Microsoft just because it's a big company that we're all familiar with, and data is pretty easily available on Microsoft. But I plugged it in, and I think you guys want to set up your problem something similar to this. Your guys' is 5 years. I used, or your guys' is 4 years, I'm sorry, I used 5 years. And I went and I actually looked, and I got information on Microsoft's actual earnings per shares versus its dividend and those types of things, and I plugged those in, and hopefully I can show you. It's because this is stuff that you'll be looking at for your project too as well. I went to Morningstar, and my computer's freezing up again. And Morningstar again is a great resource. It's going to guide you, I think, to some of the basics. But when you're working on your project too, don't forget you're going to need to get annual reports and dig those out, and dig a little bit deeper than the information that you can get. And I'll kind of explain that as we go along today too, when I'm talking about the outlines and whatnot. So, okay, come on, baby. Please go to working for me here so we can move on a little bit here. So maybe, just maybe. And again, maybe not. So who's the number 1 seeds left? We got Duke that's left. We got Kentucky that's left. Villanova got beat out. Forget. Let's see. Gonzaga's a 2 seed. They get to play an 11 seed. UCLA's been kind of a surprise. They've been playing some pretty darn good ball. And I know I'm just kind of passing time, and for that I apologize a little bit. But on the Morningstar, okay, the main page is this, and it gives me a nice basic quote, and it's really pretty cool. You probably could have gotten all the information to answer your second assignment right from this page, okay? But then you can see here it's also got all kinds of other cool stuff going on, right? And in this case, the thing that I'm going to want to look at is going to be the financial statements for Microsoft, and these are not going to be fully detailed financial statements. It's not going to be like the ones that you're going to get in the annual report, but it might be enough to do this particular assignment. Okay, so I'm going to click on that, and hopefully it'll click in and give me some of that information. Okay, and maybe I can come back and I'll show it to you when I get back there after it gets there, but I've already plugged it in. So my earnings per share in 2010 was $2.13. My earnings per share for 2014, and by the way, Microsoft has a weird year end, so that's one of the other reasons I kind of picked that. So it's one thing that you guys kind of want to watch for too with your companies, is my earnings per share went up from 213 to 266. My dividend payout for the most recent 12 months, or for 2014, I believe. I might have that wrong, but anyhow, the most recent 12 months, it was $1.18. Okay, I think I did actually put in the wrong amount there. My payout ratio then is simply equal to whatever my dividend is divided by my earnings per share. Okay, so my payout ratio, all that means is that they're earning $2.66, they're paying out $1.18, so 44.4% of Microsoft's earnings are getting paid out to shareholders in the form of a dividend. That's actually a pretty high payout ratio. And what that tells me, or what I might assume about that, and it's true in Microsoft's case, is that they're generating all kinds of cash and that they don't have use for, and so they're actually paying it out in the form of the dividend. And the other thing Microsoft does is actually buy back a lot of their stock, and I think I'll be able to show you that in a little bit as well. On Microsoft, when I checked earlier this morning, the price was $43.13. Okay, so I input information it's similar information to what you guys have. And it asks this, it says determine the compound annual growth rate in earnings. Well, I want to know what my growth rate is. I've got 5 years worth of earnings that grew from $2.13 to $2.66. Okay, this is just like the compound growth rate of if I invested $10,000 and it grew to $12,000. What's the compound annual growth rate? So we've done some problems like that back in chapter 9 even. Okay. I just have to determine what that rate is, and so rate is my formula that I'm going to use, my number of periods I have, right? My payment, I don't have a payment. I don't want to use a payment here. Yes, they pay a dividend, but I'm only interested in the compound growth rate of the earnings per share. Okay, so I'm not going to use a payment. Instead, I'm going to say that my present value was the $2.13, okay, and my future value is the $2.66. Okay, now I do need to enter that present value as a negative. Okay, I do need to enter that as a negative, as if that was money that was kind of going out. So it's a little bit of a quirky deal, but you do have to enter that as a negative, and you can tell that because my answer up here was a nothing before. Okay, so I needed to change something, and in this case, changing that to a negative will give me the growth rate. So it grew at an annual compounded rate of 4.54%, okay, each year for those 5 years. Okay, then the second part of your question is based on the growth rate determined in Part A, project earnings for next year, round to 2 places to the right of the decimal. So they earned $2.66 last year. If it grows another 4.54%, that's what we're going to assume, then we're just going to add, we're going to take 4.54% times this and then add it back to that. Okay, and in a formula we can put it this way. We can say it's equal to, okay, my earnings per share last year times, okay, parentheses, okay, 1 plus my growth rate. Okay, so that comes out to 278. Remember I said that we could do it, we could say it's like this too. It's equal to this times this. This will tell us the dollar amount that our earnings should grow next year, right? So 12 cents, and then we would simply add it to last year's earnings per share. That's my 12 cents plus my last year's earnings per share. And I end up with the same amount, right? I'm doing it the longhand way there. Okay, so what's my projected dividend? Same thing. Okay, I think that's your guys. Assume the dividend payout ratio is 40%. Now I kept my dividend payout ratio at 44.4. Okay, compute D1 and round to 2 places to the right of the decimal. So I've I've got to your guys is you're going to have to take it a little different. You got to compute D1, and so you've actually this will be the same way. You know what your earnings per share is projected because you've done that. Your payout ratio is 40%. So determining your projected dividend is simply as easy as saying this is equal to my payout ratio times my projected earnings. So $1.23 in my case, in Microsoft's case, if their dividend payout ratio stays the same. Okay. And it goes on and asks the current price of the stock is $50. Using the current growth rate from Part A and D1 from Part C, compute KE, or my cost of capital, right? My cost of capital. Okay. And the formula again there, 360, page 362, page 360, 162, I think. And the formula there is determining my cost of capital is just simply the dividends divided by the price plus the growth rate. Okay, so the dividend, okay, divided by the price plus the rate of growth. So I can plug that in and say that it's equal to the projected dividend. And I think I'm going to need a parentheses here. So the projected dividend divided by the price, projected price in this case, plus the growth rate, which is the 4.54%. Oh, I got something wrong there. Did I miss out? Equals. Oh, shoot, I'm taking it by the earnings per share instead of by the price. Shame on me. Golly. Read my equation. It's the dividend divided by the price, not the earnings per share. Golly darn. Okay. Equals my projected dividend. I could tell by looking at it that that was off. Divided by my price. Golly. Plus the projected growth rate. And it's just oops. Sorry, it's extending it out too many decimal points, so I got to eliminate a bunch of the decimals to get it. So my cost of capital here is 7.4% for Microsoft, meaning if they issued some new stock, not counting the float cost, okay, it'd be 7.4%. Our next problem is going to be what if we added in the float cost? What would that be? If the float cost was $3.75 per share, then what would be the cost of capital? Okay, so 7.4% is cost of capital given the current price. Then the next question is, and it is for you guys too, it's what is the cost of capital if the float cost is $3.75. And I used the same $3.75. Now my formula just adds in really that float cost, where you're subtracting the float cost from the price. Okay, so I'm subtracting the $3.75 from the price. Okay, I gotta have a few extra parentheses on this one. Hopefully I'll remember how to do this right. Gosh. Okay, so it's my dividend, projected dividend, and I'm going to need a parentheses around that, so let's put that in there right now so I don't forget. Divided by, I'm going to need another parentheses, my price, yay, minus my $3.75, and I don't have that as entered anywhere in there, so I'm just going to have to enter that. And then I'm going to need two parentheses and add that to my growth rate of 4.54%. And my cost of capital is about 7.68% for new common stock, if I were to issue some new common stock, or if Microsoft were. Okay, that seems kind of low, doesn't it? Yeah, compared to a lot of the things you read in the book. But here, remember, I've always said debt's cheaper than equity. Okay, debt's always cheaper than equity. You imagine what Microsoft has a better balance sheet than the U.S. government. U.S. government can borrow money right now at less than 2% for 10 years. Okay, Microsoft can probably borrow money for that cheap, or perhaps even cheaper. Okay, so they can borrow money for less than 2%. So their debt is far less expensive than what it would cost for them to issue stock. Okay, let's go look at a couple things where I got that information from. Okay, and this is cool stuff when you click on these financial stuff that you're going to want for your particular company, right? Microsoft had revenues of $62 billion, that is, in 2010, and those in 2014 grew to 86 billion. Okay, the trailing 12 months is what TTM means. Okay, their trailing 12 months is already up to 93. So it's a pretty impressive, actually, increase in revenues. That's about a 50% increase in revenues over that period of time. You know, unfortunately, and this is the kind of stuff I'm going to have you start looking for when you're doing your projects. Their earnings per share went from 213 up to 251. That's nowhere near a 50% increase, right? So the revenues went up by, it's close to 50%. You know, that'd be a $31 billion. So yeah, it's close to 50%. What am I thinking here? Well, I'm thinking then that their costs or perhaps their cost of revenue, which has taken some big jumps, right? Look at that. Their revenues increased 7 million, but their cost of revenue increased about 5 million, right? So relatively speaking, their cost of revenue, so their margins are decreasing, right? Their margins are decreasing. Here, you know, what was it? Their cost of revenue was about 12%, and here it's about 20%, and here it's about 30-some%. You know, right at 30, a little better than 30. So their gross margins, that's the types of things that you'll be talking about. That's the types of things I want you looking for too when you guys are doing your project. A little bit of an aside there, okay? But those are the things I want you looking for. Here's where I got the information. I used the $2.13 as the earnings per share then, $2.66 as the earnings per share. I didn't use the trailing 12 months. Again, their year end is 06, meaning June. So they end at the end of June every year is what their year end is. Remember, year ends for corporations don't have to be December 31st. Okay, so they're trailing 12 months. Well, they would include all of 2000 and I'm sorry, not all of 2014, but it would include the first quarter of 2015 and then the last 3 quarters of 2014. So, okay, the dividend, I think the reason I goofed up the dividend is I'm going to go back to their basic quote, if it'll do it for me here. And I use their trailing 12 months dividend, and I shouldn't have, because I was basing their price on the year end, or their last, not their price, but their earnings per share and stuff was based on their year end in 2014, and their dividend, they've already paid one dividend here for 2015, and I think their dividend, yeah, it kind of, right, this is the only dividend actually that would have been of concern for that 2014 year end, 28 cents. So I should have actually gone back and looked at what their dividend payout was for the prior 3 quarters to this one here, this 5/13 of 2014. So yeah, so I kind of goofed up a little bit there in terms of that, in terms of my making this comparison to your guys' assignment. Onward, I digress. Okay, your outline. You need to do an outline for project 2. Okay, and if you look on the front page of D2L, you'll note up above here that I have a Word doc. Okay, see if I can scroll up there and show you that you guys can open up and take a look at what it says for outline. Okay, should be right here, project 2 outline. And this is what that Word doc says. Okay, it says for this part of the project you're going to create an outline for your final project 2 paper. My instructions are going to be purposely ambiguous, so, and the reason for that is every company's different. Everybody's going to find something different. I was just talking about Microsoft and how their margins, you know, their gross margin has changed from 80% to close to 70%, right? And I'd need to do the math. I'd probably do the math and get that and fine-tune that if I were going to do a report on it. But just off the top of my head, that's a big deal. The revenues are increasing dramatically. It's nice. The 50% increase over 5 years, anybody would take that. But their gross margins are decreasing. So they're having to sacrifice, it appears, gross margins for some growth. Okay. Again, I'd have to read their annual reports to see what they're saying about that. So anyhow, here's the things that absolutely have to be in this outline. In addition, do not forget an introduction and a conclusion. Okay, I get far too many of these papers that don't end up having an introduction and a conclusion. Remember, any good paper, you need to tell me what you're going to tell me. You need to tell me, and then you need to tell me what you told me. Okay, so always have at least an introductory paragraph and a conclusion or a summary paragraph or more. Okay, and these are at the minimum the things that you need to include. And again, your company may have something that's you know, it maybe needs to have its own another subheading. Maybe the recent merger or acquisition or something like that, you know, might be very important for that. Okay, but you're going to tell me a discussion about the industry in which your company competes. Okay, you know, you ought to be able to find some data on that. You know, if you're doing firearms, what's total firearms sales? in the United States. Yeah, what percent then does your company have? If you're doing clothing, what's the total clothing sales in the United States? Okay, and maybe there's subcategories. Maybe it's athletic clothing, and do a little research and find out what the industry does. If it's athletic clothing, you got Nike, you got Under Armour, you got Lululemon, you got a few like that. Okay, what's that total industry, and where does your company fit in that? So that's don't just tell me that they're in the athletic clothing industry. They sell shoes and apparel. Okay, yeah, but what is that industry, and how much does it sell? What percent does your company make up? Sometimes that's hard to come by, and I understand that. But some of those basic industries, it shouldn't be that difficult to come by. Okay, brief history of the company. And this you can kind of keep brief, but I kind of want to know, tell me when it was founded, maybe who the founders were, how and why it's kind of grown through the years a little bit. A discussion about the company strategy. You should be able to find that in the annual reports. Okay, and again, I always think that there's about two basic strategies, and that would include the differentiation or low cost. And so you kind of ferret that out from what your, the annual reports say. Your company might say that their strategy is, to provide the highest quality apparel. That's a differentiation strategy then, probably. Okay, versus a low cost. Walmart's probably going to be a low cost. Okay, and so you're going to have to kind of read through that and make some best guesses about what there is. And then we're going to have an in-depth analysis of the financial data. And I got that in bold because that's where I want your paper to be concentrated, right? You're going to have 5 pages, so you're going to spend a half page on your introduction and half page on the conclusion. So a good paragraph or so about the industry. Again, it might depend on your industry, and how much it takes. Same with the history. Your company may have a very long history, it may have a short history. Okay, and then a discussion about the company strategy again. Okay, so a few paragraphs here. Then I'm expecting a decent analysis. Okay, and that's why I'm giving you a little extra time and not having to do assignments for the final 3 weeks. Start looking. Spend time looking at the numbers and stuff, just like I was doing with Microsoft there, right? When I clicked on their financials and I click on their key ratios, and right, and I try to make some sense of some of these things, and sometimes it's just kind of reading down and saying, oh, that's kind of weird. Okay, and one other thing with Microsoft that's interesting is weighted average shares outstanding. By the way, diluted means that they've probably given some stock options to employees, and Microsoft is big time in stock options, and so those are shares that their employees would be able to exercise, and that's why they would call that diluted, and that's why there's 2 different numbers there. But look at that, they've gone from 8.8 billion shares outstanding in 2010 to 8.2. So they've bought back $600 million at 40, call it $40 a share. Okay, so that's what, $24 billion in stock that Microsoft has bought back, in addition to paying a pretty sizable dividend. Okay, so is that something that would be worth talking about? Yeah. Okay. Again, I can kind of look at the numbers. I can kind of do a little math off the top of my head, but I probably ought to get into the annual reports and get some more details. Okay. What's an outline look like? I'm going to go over this. I know this may be old hat for some of you, but I get too many outlines that aren't actually outlines. Okay. Use Microsoft. They Word, most of you have Word, and that's fine. Or if you get another program, they probably have something similar. But if you come right up here, it's just going to give you the basic format of an outline, right? And I kind of prefer this one. Take your choice. I don't care which one you want to use. This one's got the little Roman numeral for the first one. And I've already told you, right, that you have to have an introduction. Okay. You'd probably put a heading up here too for your outline that's going to be XYZ Corporation, outline. Okay, so I'm going to have an introduction. I may not need anything else under the introduction. That's fine, because there's, you haven't written the paper yet. You don't know necessarily what your introduction is going to be. Okay, Shoot, it should have automatically brought that up, and of course now my computer's going to freeze again, and it did. Oh, there it is. Okay. Huh, it should have brought that up automatically. I don't know what the heck the scoop is here. Well, I'll be doggone. Okay, why isn't that doing? Okay, I had to go up and click on that thing again, and I'm not sure why, but anyhow. So then my second thing, and I've given it to you, right? It's going to be, you know, what's the industry? So, industry. Okay. Dang, I don't know why that's not, it should be automatically doing that instead of me having to click on that. So, but sometimes I've got this thing set maybe to not automatically. Huh. Now, so I'll just come up here and click on this again. Okay. So, you know, athletic apparel, right? Did I spell that right? Okay. And I might, hopefully your guys' will work automatically. But, okay. But this is what an outline looks like. You don't have to use the automatic thing either. I guess you can kind of do it yourself. But normally it works automatically. I must have a setting wrong on here where it's not just automatically doing it. So I might put in here, you know, basics about the industry. You know, $20 billion industry. Boom. Okay. That's all I need. And then just keep going down to my third one is my fill in some points on here, though. I expect you to start doing some of the research, right? And so I should know enough here. History of company. I should know enough here that I got a pretty good idea of the direction that you're going. Okay, so the history of the company might be, you know, started in 1989 or something, right? Okay, fill me in enough details here that I at least kind of know where you're going. Okay, same thing with the financials. It's time to start researching the financials. Now, are you going to change from your outline to your final paper? I would absolutely expect you to. Okay, and so you're not going to be locked in just because you put something on here. You might find something that's far more interesting to discuss. Okay, so your fourth thing is going to be, find my cursor there. Oops. Your fourth thing is going to be the company strategy, and your fifth thing is going to be the financials. And I would expect under the financials you'd probably have several subpoints. Up here you might only have a few subpoints. That's fine. But under the financials I'd expect you'd have many. Okay. People tend to, in the past, they tend to not dig into the financials. Okay, and so, you know, they might tell me about the revenue growth and they might tell me about the earnings per share growth a little bit, but they're not equating the two, right? Like I did say with Microsoft, or, you know, there might have been an acquisition, or there might have been a big drop, okay, in a company. You know, I might want to go take a look at why did in 2011. Look at that, we had a huge increase in income from 2010 to 2011, but look at 2012. Ouch. And we didn't recover. And why is that? Okay, that's one of those points I'd want to talk about. You know, what happened in 2012 that earnings per share took a big dive? Okay, it's something, it's some special event. I'm going to have to go take a look at it, right? Okay, I'm definitely going to have to go take a look at it and see what it is. You know, they're operating. Oh, here, look at that. Other operating expenses, a $6.2 billion charge. Okay, I'm going to have to go all the way back and find their 2012, okay, financial statement, the annual report, and figure out what that $6.2 billion charge was. Okay, they wrote something off. That might have been about the time they were getting in bed with Nokia. Okay, and they might have rolled off some of the charges based on acquiring Nokia. I'm not sure. I'm just kind of guessing, going by kind of what I've seen in the news. So those are the types of things that you really need to look for. Okay. Yeah, that's kind of cool charts. Look at that. It tells me what my gross profit has done. It's grown. Yeah, interesting. Okay. And then, of course, you're going to end up down here with a conclusion. And that's going to be number 6. It should be. Again, you might have something else in there, right? You might have another heading that you want to put in there because your company is unique, and that's fine. Okay, you shouldn't have any less than what I have on here. I mean, I fully expect you're going to tell me a little bit about the history, a little bit about the strategy, and a little bit about the industry, and a whole lot about the financials. Okay, so I can't imagine you taking any of those out, but you might add something if your company has a compelling thing that you want to tell me about that's important to the story that you're going to tell. Okay. Make sure you leave plenty of space for the financial analysis, however. Okay, because that's going to be the important part. So I hope that gives you an idea. Again, this is what an outline looks like, and build that outline, get it plucked in there so I can take a look at it, and give you some ideas about where you maybe should go, unless your outline looks really good and I don't have to worry about it, which would be wonderful. With that, it's definitely time to sign off. So have a great week.